Hi, welcome to all the listeners. This is Nikhil here, and this is our second session of Know Your Mutual Fund series. Today we have with us Mr. Jayesh Sundar, who manages Axis Balanced Advantage Fund. And today we'll have a conversation with him to understand more about how the fund is managed, how they are seeing the category, and what in general is the house view and the fund manager's view on the positioning of the fund. So, yeah, we can get started. So, hi, Mr. Jayesh. Thanks for taking your time out today with
Hi.
us. And
Thank you.
yeah. So, if you could quickly give a brief introduction about Balanced Advantage category as a whole, and maybe somewhere how Access is positioning it, that will be helpful for beginning, and then we can get started with a few more questions.
Sure, sure. So balanced advantage falls under the hybrid category of funds, where, if you typically look at the hybrid space, you have a number of fund options, some which falls under the conservative bucket, where the equity portion is limited to maybe around 20-25%. And then you have the aggressive ones, which have equity portion, which can go up to 65 to 80%. And balanced is something much more versatile, much more flexible, has a higher range in terms of how the equity can move. So to that extent, that's the unique advantage or the unique feature of this fund, that it can take advantage of the market cycles. Like I mentioned, that it's a hybrid category of fund, so it can invest both into equity also, and also the fixed income portion. So what essentially happens is that a balance is tried to reach between these two asset classes, depending upon which looks more attractive in terms of risk reward. From a valuation standpoint, the macroeconomic factors, lot of micro factors, and then the asset allocation is decided by the fund managers, both on the equity as well as the fixed income portion. So the idea here is to take advantage of the market rally, so to participate in the equity market to a limited extent, but also have some cushioning in terms of volatility. So the fixed income portion will cushion the volatility of the portfolio, and also generate some reasonable returns on the fixed income side. So it acts as a risk mitigating measure also, and also generate some steady income on the fixed income side. But and on the equity, it tries to gain the upside from the by participating in the equity markets. So, like I mentioned, it's a flexible, in terms of asset allocation. So, typically, depending upon the internal mandates, equity portion, for example, can range between 20% to 80%, or it can even go as low as 0% to 100%, depending upon the internal mandates. So, which means that you can really play the entire cycle. So, let's say we are seeing an extremely pessimistic scenario, or markets are not conducive at all. They are going through a down turn in terms of an economic cycle. The equity allocation can minimized, and the fund can focus on having a steady return generation from the fixed income side, and vice versa. When the market is coming through from a down cycle, and growth is starting to look up, valuations are attractive, it can maximize the equity and take the full advantage of an equity market cycle as well. So that's how when balance is achieved. And also the fund manager periodically reviews this its equity allocation or the asset allocation, and it is periodically changed depending upon the circumstances, to get the maximum advantage from both the asset classes.
Right. Great. Thanks for the overview. So, since you mentioned that the fund invests both in equity as well as fixed income, and the percentage allocation also keeps changing based on market and other various other factors. So, if you could help us understand how the fund is positioned today, both in terms of equity and fixed income, and what is, say, the rationale for positioning it that way.
Sure. Sure. So, right now equity is roughly about 67% as percentage of the total AUM of the fund, and the balance is the fixed income portion. So while we are still positive on the markets, but yes, I mean, in a lot of places we do see that valuations are not exactly in the comfortable position. If you see at a market overall, if you look at Nifty 50, for example, valuations are one standard deviation above what it used to be in the historical averages. So it's not a very comfortable position, but at the same time, we are seeing very good traction in terms of earnings in specific sectors. Where we are seeing continuous earnings upgrades, which happen. So typically, our approach has always been that valuation cannot always seen as a standalone basis. You have to look at earnings also and take into consideration the earnings growth as well. So there are a number of sectors where earnings growth continues to see a strong recovery or an upside surprise. So those are the sectors where we are focused on. So a primary call being that we are reasonably positive, but valuation and global macro is something which keeps us back from going full throttle into the equity markets. So like I mentioned, roughly we are at about 67%. And within that, we are looking at sectors where earnings traction continues to be surprising on the positive side, and cycle seems to be favorable. So, for example, if you see auto as a sector has been seeing a good amount of earnings upsides and earnings surprise. So that is a major overweight in the fund. Secondly, the capex and the investment theme has been doing pretty well, driven by the government push. And the government has taken a number of measures to ensure that there is a conducive investment environment, and whether through the PLI schemes or the subsidies or through the policy measures, there's a good amount of investment which has been taken in the through in the last couple of years. So that is another segment which we believe that will continue to do well, given that a lot more needs to be done, and we are just in the cusp of a long investment cycle. So, for example, power is an area where we are very, very positive on. The entire theme on the power started when the government focused on manufacturing, whether to substitute imports or to make us export competitive. So once manufacturing has started to pick up, obviously power demand has gone through the roof, and we need the capacities earlier or sooner than later. And there's a lot of thrust in capacity additions across the board, whether it's fossil fuels or renewables. Across the board we are seeing capacities being pushed through. So that is a segment we are positive. Again, from both indigenization or an import substitution point of view, defense is another sector which looks extremely attractive. So defense, if you see, the primary goal was indigenization and to substitute imports, and we have been fairly good at in achieving that in the last 1 year or so. And a lot of road still needs to be covered. But the other theme which is also playing out is a lot of these defense companies, the PSUs especially, are becoming competitive as they gain scale, as they gain technological competence, and export inquiries have started to pick up. So that is another revenue stream which is looking very interesting as of now, and probably we could see meaningful revenues coming from the export areas also. So, all in all, yes, auto, defense, power, these are the themes which we continue to like. But what we also do in the portfolio is that, not to not make the equity portfolio also extremely volatile or high beta, we'll try to balance it out with some defensives. So, pharma is a sector, or healthcare or diagnostics is a sector which we like, again, on a structural basis. And as we see, awareness increasing about, having fair bit of on the healthcare side, there is aspiration to go for quality healthcare, and to be preemptive about healthcare. So consumers are being preemptive and want quality healthcare. So we are seeing fair bit of traction on the pharma side as well. So that is again a sector which we like from a longer term perspective, and that is a sector which we think that also cushions the portfolio from any volatility.
Right.
Uh, on the underweight side, commodities is something which we are not very comfortable at the moment, given that globally things are not looking so rosy. Inflation has been a big headwind, and we have been facing continuous rate hikes till now. And though yes, we have seen the worst of inflation, and looks like probably the rate hikes also. But having said that, the rate cut cycle is something which we believe is still some time away. So given that backdrop, growth seems to be some bit of a challenge globally in some of the geographies, for example, China and Europe. So with that thought in mind, we are underweight on the commodity side. On FMCG or the staples, again, growth has been trending downwards, primarily because rural as an economy has not been doing that well. And we have been hearing, about this K-shaped recovery quite again and again from many quarters now. And, because of which, the bottom end of the pyramid is not doing so well, which is impacting the FMCG demand as well. So that is another area where we continue to be underway.
Great, great. Thanks for sharing in much detail about the sectoral exposures. So, once you have decided the sectoral exposures and the overall asset allocation, how do you approach selecting individual securities? So, you mentioned about earnings growth
Sure,
and valuations, but
sure,
is there anything beyond that that kind of narrows it down or help or aids you in the security selection that
sure,
finally comes into the becomes a part of the portfolio? And also,
sure,
what is the approximate time horizon that you at least initially look at while investing, which may of course change as facts and data change. But what is the
sure,
approximate time horizon that you have in mind while making an investment?
sure. Thanks. So, Nikhil, what I'll do is I'll touch upon some of the changes in the approach which we have brought about, and then I'll cover what has been the thought process in making the changes in the asset allocation and the portfolio positioning. So, typically in a balanced advantage fund, the way it happens is that the asset allocation is dependent upon number of factors. Now, typically, historically, we used to follow a model-based approach where there are a lot of inputs which go into the model, and the model will throw out an output in terms of an ideal asset allocation. Now, a lot of these inputs tend to be macro heavy. So they take into account the industrial production, the PMIs, inflation, interest rate curves, etc. So it tends to be macro heavy. What we try to do is to build in a lot of micro factors, also sectoral, or company specific factors also into this one to make it more broad based. The other area also which we try to incorporate is some of the softer aspects. So, for example, geopolitics, which has gained a lot of importance in the near term. Though sentimental, but yes, I mean it does have fair bit of impact on the market as well and on the volatility. So we thought that it's a very important factor to consider. Similarly, on the software aspect, something like FII flows also is something which we try to incorporate. So what we did is that, instead of relying completely on just a model, what we try to do is make it more broad based. So macro, yes, one needs to definitely look at macro to get a clear picture of what is happening in the economy, where do we stand in the cycle, and accordingly, what should be the positioning. But accordingly, it should be matched by if I have bottoms up investment ideas which are reasonably priced. So on the macro side, what we did is that look at which are the sectors or the themes which are seeing good amount of earnings traction and where valuations are at a reasonable level and are attractive investment opportunities from a from a medium to long term perspective. So both these factors have to match to really for us to decide on the ideal asset allocation. So macro might be really conducive, but if valuations are not not only the nifty valuations but also at a sectoral level, if valuations are not in a comfortable position, or we are not seeing enough opportunities where we can see earnings traction match up with the macro, then we may not go full throttle on the asset allocation part. Accordingly, this also helps us to decide on the market cap mix as well. So, one point which I probably missed in the initial remarks on the balanced advantages, basically, this fund is completely flexible as far as the market capitalization as well. So typically, given that it caters to a slightly conservative set of investors, it tends to be large cap heavy. But having said that, there is enough flexibility to add mid and small caps as well, depending upon the situation. So let's say there is a situation where we are coming from an earnings down cycle and there is a good bit of comfort on valuation on earnings. The fund can have good amount of exposure on the small caps as well. So this bottoms up approach also helps us in deciding on this market cap mix as well. So today we are a bit large cap heavy, as you might have guessed that given that small cap, there is some bit of concern on the valuation. So we are large cap heavy, but we do have a fair bit of exposure to the mid and small cap as well. So continuing on the discussion on the approach. So basically, what we do is that we have an asset allocation committee which meets on a monthly basis. And this asset allocation committee, there is a discussion on this entire three pieces which I mentioned. One is macroeconomic factors, one is bottoms up investment ideas where earnings and valuations seem reasonable. And the third is softer aspects such as geopolitics. So we discuss all these three factors and then finally arrive at what is the ideal asset allocation mix which has to be mentioned. Uh, Now, on a monthly basis, though there is a discussion around it, we may really not change, or we may change depending upon the circumstances and how market really behaves, and what is our assessment of all these three factors. Also, monthly is just a frequency to really review the asset allocation. We can do it on a more frequent basis if the situation demands. So let's say there is some black swan event which has happened, there is some geopolitical event which has happened. We can quickly reconvene and decide that yes, I mean we need to change the asset allocation or either positively or negatively, and accordingly take the action. So it is not only flexible, it is very much quick to react to market circumstances and doesn't have to really wait for a particular time frame to go through before we take the asset allocation call. So if I can give you a recent history, November is when we made a big change to the asset allocation recently, November 2023. So we thought that there is a fair bit of certainty on the election front. The reason I say this is because typically every election year you see a good amount of volatility happen in the markets, and government also goes into a campaigning kind of a mode, so things slow down. But this time we thought that given there is a fair bit of certainty on the incumbent government coming back with a strong majority, we thought that there is still upside on the markets. And globally also, like I mentioned earlier, that at least the peak of inflation was behind and the peak of interest rate hikes were behind. So we thought that globally and domestically, macroeconomic factors are falling into place as far as overall market is concerned. Now, like I mentioned, that we tried to match it with the micro factors also. So we looked at which are the sectors where, are there sectors, first of all, which are seeing earnings traction, and are there, valuation comfort in these sectors. So we saw that some of these sectors like auto, capex, your defense and power themes, financials, for example, are seeing good amount of earnings traction and are available at attractive valuations.
Right.
So, which is why we increased our asset allocation from 60% to 70% during that period, uh, participating in these sectors. And we've had a good result in the last 3-4 months from the positive traction in these sectors. Uh, of late, we've done some bit of profit booking, but broadly stay in that 67% equity range.
Right. Right. Got it. Great. And also, if you could touch up a little bit on the debt part, fixed income part, how that is
Sure.
positioned today,
Sure.
in both in terms of say duration and in general the exposure, that will be helpful.
Absolutely. So again, on the fixed income portion as well, when October, November is when we saw the first signs of inflation peaking out. Month on month basis, we saw that the incremental impact on inflation wasn't that much, and we saw cooling off in number of factors. And accordingly, central banks also toned down their commentary on the hikes. We saw that yes, this is a time to really go high on the duration. So typically, just like we do on the equity side, on the fixed income side also, it's quite flexible as far as the duration calls are concerned, and is quite actively managed. So we increase the duration of the portfolio on the fixed income side. Uh, Having said that, typically, again, we tend to be higher on the AAA rated papers or the government securities, so which continues to be a majority part of the portfolio on the fixed income side. But within that, we have a higher duration with the view that in the next year or so, we will see a rate cut starting to pan out.
Right, right, got it. Great. So that's really helpful on the overall asset allocation and general security positioning and sectoral positioning. So thanks a lot for sharing that. Now, if I ask from the investor's perspective, uh, for which kind of a risk profile and duration would you say does a balanced advantage fund be more suitable from in your view?
Sure. Great. So that's a great question, Nikhil. So typically, like I mentioned, this is a product which is quite flexible in terms of equity allocation, and also, it caters to a slightly conservative set of investors. So if you typically look at first-time investors, they are a bit skeptical about equity markets. They are still learning about it, and the equity market has a fair degree of unpredictability in at least in the short term. So it's a product which is fairly suited for the first time investor, where they get to participate in the equity market, and also with lower volatility, and the fund manager takes the asset allocation calls for them instead of them having to take it and go through the hassle of rebalancing on a periodic basis. So that's a good product for somebody who's new into the equity markets. The second set of investors who can also look at this fund is somebody who's closer to retirement, so they have made bulk of their wealth, and now they want to participate in the market upside, but to a limited extent, but also limit the volatility of the portfolio, riskiness of the portfolio. So they are the second set of investors who can really look at a balanced advantage fund. Uh, Thirdly, a hybrid fund is also advantageous in situations like we are facing currently, where markets are at all-time high. Yes, I mean certain themes are playing out, but at the same time, it's not a very comfortable situation as far as valuations are concerned. So the question, obviously, typical investors have is, we are already at an all-time high, so how much more? In such circumstances, also hybrid funds can be extremely exciting, because it gets to participate in the relevant themes without having to be in the broader markets. So in situations like this, also, a balanced advantage or any of the hybrid funds would be a good option.
Right. Great. Great. Thanks a lot, Mr. Jayesh, for sharing so many insights about the fund. I'm sure the users and our listeners would have much more understanding about the balance advantage category and access balance advantage as a whole. So I would really like to thank you for taking your time out and sharing the insights with our users, which is usually not available very easily. So much appreciated. Thanks a lot.
Thank you. Thanks.
Yeah. Thanks.